All right. Well, good afternoon, everyone. Thank you for joining us here on the first of our Financial Fridays series here, hosted by Thimble Island Private Wealth. My name is Matt Fleming. I'm a certified financial planner here with Thimble Island Private Wealth. And again, we appreciate you taking some time today to hear a little bit on some of the new Tax Act changes from that one big, beautiful bill act from a little bit earlier in the summer months. So today, our hope is that we can give you a little bit of an insight into some of the changes, maybe some of the things that might affect you going forward, and a little bit of an overview on maybe some strategies that we could potentially help you with in terms of portfolio construction and strategies to maybe take advantage of some of the things that we're going to talk a little bit about here today. So before we jump in, just a little bit on who Thimble Island Private Wealth is. If you're not familiar with us, we are a full-service financial firm located in Branford, Connecticut. We help individuals, multi-generational families, businesses with their finances in terms of putting together organization and plans for the future. Wealth management is really a dynamic process. And each situation is unique. So with that, we lean heavily on creating custom plans to help folks evolve as life's uncertainties and changes come up. We really use that as a guide to kind of help us with portfolio management and helping you sort of achieve your goals there going forward. So we'll talk a little bit more here at the end, just again, a little bit about some opportunities we might be able to help you with here today. But hopefully here over the next 30 minutes or so, you'll get a little bit of an insight into some of the changes. And with that, I want to introduce Steve Moalli, who's a partner at Bailey Scarano, a CPA firm here in Branford, Connecticut as well, just down the road from our office. And Steve's joining us today to, again, talk and impart a little bit of wisdom to us here in terms of some of the changes that we saw a little bit earlier in the summer months for some of the tax changes. So again, Steve has joined Bailey Scarano in 2007. He's again a partner within the firm, has really led that firm's expansion into the credit union services division. He's got a very deep knowledge across all industries and personal tax planning opportunities. And again, actually probably one of the most noteworthy things is that he's a North Haven native, but he now resides in Northford, actually just across the street from my family as well. So Steve, again, we really appreciate you taking some time here today to talk with us a little bit about some of these changes. And just a housekeeping thing here, I apologize before I turn it over to Steve. If you do have some questions, definitely hold those till the end. There's the react button where you can actually kind of raise your hand so we know that you have a question, and we'll be able to mute you at the end and address some of those questions there, hopefully. So with that, Steve, I'm going to give you control here to the slide presentation. And again, we really appreciate the time today.
Beautiful. Thanks, Matt. Appreciate it. Appreciate you guys inviting me on here to talk a little bit about this. Yeah, enough about me. I think you guys get it. Our firm in general, we work with small, closely held family businesses. So, our kind of wheelhouse and what we know the best is, the mom and pop shop up to, the company who may be doing $100, $200 million in sales, but is closely held, closely owned. So that's a lot of what we do, along with working with the individuals and the trusts and things associated with that on different levels. So one of them is tax. That is obviously a big part of what we do here. So, on the OBBBA, hold on, see if I can get there, Matt. Just want to see if I can get to the next slide here. Let's see. I don't think it's going to the next slide there, Matt. You may want you to. Maybe I got it down here, can I? Let's see. There we go. We got him there. So just the title slide there. So the one thing I would just say overarching with this bill, I mean, there's a lot in the bill, as people heard, to kind of focus this down, take like an 8-hour presentation, say, break it down into 30 minutes. I want to just hit the big items. the things that people have heard a lot about in the news, probably don't fully understand. Kind of as, it's in the title, it's like what does impact you, what doesn't, what are the big items? And here, I think the biggest thing is there's a lot of technical memoranda still coming out on some of this, so how things may be implemented aren't fully there yet. Not the end of the world, but as people ask questions, as I go through here, I'll try and point out certain areas where that may be the case. So kind of focusing on the individuals here first, the biggest thing was this was an extension of the Tax Cuts Jobs Act that we got from Trump's first time around in 2017. Essentially, most of these provisions were due to sunset here in 2025. This extended pretty much everything there, some modifications, but for the most part, it was an extension through 2028 of what we had. Kind of was anticipated when he got reelected. We knew that we'd probably have a lot of these same tax rules and laws that we had. So as much as it's an overarching large tax bill, it's a big extension from what we had. So a couple of the big things are, the increased standard deduction. So this is kind of a big one. As a tax preparer, we would look at itemized deductions for many, many years. That was a big way people saved money on their taxes. When the Tax Cuts Jobs Act came out, that doubled the standard deductions. That meant a lot of people were no longer itemizing that did for two reasons. One, right, these standard deduction numbers are pretty big. So that's one reason. And then there was also the SALT, the state and local tax deduction limitation. That really, between those two things, a lot of people fell down to taking the standard deduction. So we've got that still. We're probably going to have a lot of that. Tax planning stuff. What do we try to do with that? We try to lump deductions, if we can do itemized deductions, into one tax period. So say you're somebody who wants to be charitable, you're not somebody who's going to be donating $50,000 or $100,000 a year. So you're like, hey, I want to donate $5,000 a year, but I want to do it for the next 5-10 years. Maybe you look at setting up a charitable donor advised fund to try and bang that money in there, get that charitable tax deduction all up front in the first year, but then you have 5 years or longer, to give those charitable donations out for. So that's just one way you can kind of look to how can I get itemizing in certain years if I'm not going to itemize every year to kind of really get the benefits of still itemizing sometimes. Another big one I've heard from clients or questions clients have asked is like, what's this whole thing for older people? So we have an additional $6,000 deduction now for taxpayers over 65. So that's pretty good. On top of, say, you're a married filing joint taxpayer and you've got 31.5 of a standard deduction. Now you've got double deductions for 6,000. You have 12,000 more on top of that. I mean, you're going to have $43,500 of tax deductions right there, which is going to help elderly people, I think, or people that are over that age bracket that could still benefit from some deductions that aren't itemized, things like that are just standard across the board. There are phase outs to these things. So everything I say has got qualifications to it, right? And we're not going to dig into all the details, but that one, for example, that does phase out for married filing joint taxpayers at 150, I believe, and for single taxpayers at 75. So another reason maybe do your planning up front, right, with guys like Matt and their team over there, where it's like, hey, can we put money in Roth IRAs and things? So when I go to take that money out when I'm older, I don't have to include that in my income. If you can get under those numbers when you're retired, it's a big thing, big benefit. Second, or another point I just brought up is a lot of people talked about Social Security wasn't going to be taxed, it's still subject to the same tax rules that we had before. So, unfortunately that didn't make it in the bill. It was going to be a big expense to have that in there as well. If we can get perfect. So estate and gift tax implications, it was set to go back to $7 million, I believe, in 2025 or 2026. We kind of assumed that would probably be extended, especially with Republicans getting in. So that did not only get extended, but they raised the lifetime exclusion of $15 million per person. So, if you're one of those people that was in that close bracket wondering, do I need to do planning? Do I not? Not that you won't want to do planning, but now, as a married person, we're talking $30 million of federal exemptions. That's big. The other thing is you don't forget about the states, right? States have different thresholds. Most of them are lower. So we still have to look at our state and know, do we have issues going forward? But that was a big part of the bill. And that applies to decedents after December 31, 2025. So unfortunately, this isn't something that's retroactively happening. Earlier this year, somebody did pass away, and that will be adjusted and indexed for inflation going forward as well. All right, so then we talk about the itemized deductions that we have here. So not major changes, but we do have changes for the first time in a while on some of these things. I'm not going to go into all the details, but there are some limitations on high income earners now. There was some reinstatement of AMT and things of that nature that have changed as well. But there could be, I think, up to like 5.4% of your itemized deductions could get limited if you have too many of them in certain areas. Won't get into all those details today. We could spend a lot of time talking about that. But some of the ones that affect most people, or maybe the average person, PMI. So that's been something. So you buy a house, you got the mortgage insurance you have to take as part of the loan. Pretty much those limits, most people would fall over them. They were 75,000 and 150,000. Married filing joint for your income limitations. They've now lifted the income limitations, and now it's going to qualify as part of your mortgage interest. So essentially, just give some people a couple more $1,000s of deductions if they're paying PMI when they go to, buy a house. Wagering losses. So this is one people come to me all the time and is a tricky one because they come and they say, hey, I won $100,000 at the casino. Great. But then I lost it all, that same day or the next day. And I tell them, well, we still owe taxes usually. So here in the state of Connecticut, the issue is Connecticut doesn't allow for itemized deductions. That's why I say keep in mind your state limitations, because wagering losses are a state or an itemized deduction that not all states allow for. So what would happen is in the past, you could write off 100% of your losses against your income, and that wasn't a problem for federal tax purposes. Now they've got a cap. So what's happening is they're going to say you can only deduct 90% of your losses. So give an example using round numbers. Somebody wins $100,000. They lose that same 100 that same day or throughout the year. So they say I'm break even. Well, now you're only gonna be able to take 90,000 against that 100,000 if that's your loss number, and you're gonna have 10,000 taxable income at the IRS level. Now if you lost 120,000, you'd be 90% of that number is more than 100. You still can't go over the 100, but you'd be able to offset all of it. But it's just something to keep in mind if somebody happens to have a big windfall, wins, especially with these online things we see a lot of times with the DraftKings and the FanDuels and all this stuff. People get forms and then they're trying to substantiate losses. Well, now you're going to have to substantiate more than 100% of your income to get there. So that's an interesting one that I feel like didn't get a lot of talk out there in media. And then we have the SALT deduction revision. So this is good, for us here in the blue states that have high income taxes, high property taxes, things like that. Right. So now they have revised it up to 40,000 for married filing joint and single, starting this year that we're in right now. And there is a phase out range, but that doesn't start till 500 of modified adjusted gross. So we will see more people now maybe itemizing if they have that high state income tax, high property taxes, because that alone sometimes makes somebody itemize, even if they don't have a mortgage. Typically, it was the person with a mortgage, property taxes, everything that came along with it. But maybe now this is going to get you there. And it's interesting, not talking too much about the businesses right here, but how this will impact, because right now we have these pass-through taxes getting paid through businesses in a lot of states to avoid this. I think states are still looking at this. Are they going to change rules? There are some little changes out there in some of these states. But right now, for example, here in Connecticut, we're leaving the pass-through tax is still a thing, still good to get the business tax deduction for it if we can. So we're still recommending people pay that if they're in that scenario and can do that. Then we're going to go over and talk about tips. So I think this was very much a big part of the bill. And there's, I don't say confusion, but there's a lot of people asking questions about, well, how does this exactly work? And how am I going to know what to deduct, how to deduct it? So the big things, up to $25,000 of tips may be deducted annually. And that's a lot for people that are in these industries that kind of rely a lot on tips. It is going to be a separate deduction on your tax return. So doesn't mean you need to itemize, doesn't mean the matter if you take the standard deduction, it's going to be a separate line item, a new line probably on the tax return. That's what we are thinking, seeing. Again, some of these technical memoranda are coming out to discuss this and how exactly it's going to be implemented. But, you know, on W-2s, if you're somebody who's been in these jobs before, you probably know tips are already separated on a W-2. So most likely that's what we're going to see. It's very similar treatment now. Is it going to be up to you as the actual taxpayer or the tax preparer, say, to decide if you're in an industry that should get it or not? Probably. I mean, it's very rare I see somebody come in with a W-2 that's not in one of these customary industries. They have expanded the list. There's an IRS listing out there. You know, it's most of the ones you would think. What they were trying to do, they're as with usual with these bills, they try to avoid anti-abuse stuff, and they try and put provisions in there. And that's what a lot of times they're still working on now, saying, listen, as an accountant, it's not customary for me to get a tip in my world. I can't now say, okay, you as the taxpayer pay me and tip me for my services so I can deduct it. Not going to be allowed. There's a very specific listing out there. So it's the people you would suspect that are on that list for the most part. But if you have any questions, you can find that list out there as well on the IRS website. There are some income phase outs. So again, I listed them here. It's 300,000 and 150 for the different filing statuses. So what does this mean? You know, a lot of times people come to me and it's like, hey, the one spouse is a higher income earner and the other spouse, you know, works in a restaurant. It's like, well, I can claim the credit. I'm going to file separately. You can't do that here. They're not allowing you to be a married filing person separately to try and play the game and say, well, they're going to not get them taxed. You either have to file jointly to claim the credit or you're not going to be able to. So that's a thing to keep in mind if you happen to be tipping these thresholds at all. It does apply to employees and independent contractors, so that's going to be interesting. I mean, I think of the employees as the ones getting them. Not sure how the reporting is going to go for independent contractors as I sit here at the moment, where if you're, you know, being subcontracted out, maybe you're doing, I'm just trying to think, like a wedding or something, and you're not really a W-2 person of that venue and they're going to 1099 you. You know, is that going to be a 1099 box? Maybe. Still some questions that, you know, I've got out there I don't know the answers to as we sit here right now. And one of the other things is when we talk about things not being subject to tax, we're talking federal income taxes here, right? This is a federal bill. So still subject to FICA taxes, means you're still paying your Social Security and your Medicare on it. Most likely still subject to state income taxes. So keep that in mind, that it's probably still subject to a lot of these things when you're hearing this. And the other big one, overtime. So the no tax on overtime, and this was one when I heard it, was, you know, curious to hear more about it and how this would play out. Just like the tips, it's going to be an additional deduction on the return. So we're going to see, you know, a separate line item. That's where this is going to go. The no tax part, it's interesting because I think it was touted like, hey, if I work a lot of overtime, I'm going to have this big reduction in my tax bill. I don't think that's exactly how it's going to play out. So what I kind of tried to show here was just an easy example of if you're somebody who makes 20 bucks an hour, and when you work, you get time and a half for overtime, so you get $30 an hour. It's not, you know, and let's say you work 50 hours that week, you know, right? So you should have 10 hours of overtime, and you're thinking, wow, I got, you know, 10 hours times 30 bucks an hour, $300 tax free. Not the case. It's only on the overtime rate differential. So it's the $10 an hour difference that you're making that's not subject to tax. So in that example, it's $100 that you're not paying tax on. Still nice, still a benefit that will benefit people, especially people, you know, some people work 10, 20, 30 hours overtime in a week. It could be substantial. But I want to be clear that that's kind of how this is going to work. And I think there's going to be reporting on your W-2 on the overtime pay, so you don't have to make that determination. That's a big concern of people, right? Like, how do I know this? How am I going to tell my accountant this, or plug it into TurboTax, whatever it may be? You know, I think that those disclosures are going to be on there, and that's what they're trying to work through right now, is get the logistics of this out there and done. And again, this is also subject to FICA taxes still, and probably subject to state taxes as well. The next one on car loan interest. So this is an interesting one. It's going to also be a separate deduction. So don't have to itemize for this as well. It'll just be a separate line item on the return. And it's for the interest, right, on the personal use car. So if you go to the dealership and you buy a brand new car, and it does have to be new, I want to specify that, you know, we're going to get to write off the car loan interest potentially. So this is for the next 4 years here, the current year we're in, plus the next 3. The big thing is, right, not all vehicles qualify. So it's got to be original uses with you, must be new. One of the things I actually just saw a seminar come out yesterday with, I think there's like some relief for, I don't know if it's going to be the dealerships or the lenders probably, and the bankers trying to figure this out, because I think they're going to be disclosing to you if you meet and qualify for all of these things. And I think they're still trying to work on how is that going to be disclosed to you. Probably like a 1099 form, just like you kind of get for your mortgage. You get a 1098 for your mortgage. It'll be like the same for the car. But I think they're going to make some of these determinations as far as, was it assembled in the US? Is it secured by a first lien? These things, because you may not know all that information. So hopefully that comes to play, and we're not trying to figure that out. As tax preparers, we never like to have to do a lot of research trying to figure out things like this, but there's a whole long list of rules. But I mean, the good thing is, if you qualify, it's a lot of money we're talking about, the interest rate environment we're in right now, that, it's nothing for somebody to pay $5,000-$6,000 for their loan interest on their car now. So this could be good. And it is a max deduction of $10,000 a year. So again, pretty high cap, I think there. That's going to be a car that's pretty significant if you're over that number. And there is a phase out once again. So I kind of put them in here. It's 200,000 married filing joint, fully phased by 250. So usually you cut these in half if you're looking at single taxpayers, but that's where we're at here. Refinances do qualify. So I'm thinking, if you bought a car and then 3 years later you refinanced it, but that was still your original used car and it was a new car when you bought it, I think that interest would still qualify, the way I understand it. And like I said, the lenders are supposed to be reporting this down to you. So hopefully we won't be worrying about that. There's some other little nuances, like the car, most cars qualify, most trucks, things of that nature, but it can't be a really large vehicle that's over 14,000 gross vehicle weight rating. Most people aren't buying that for personal use, so I don't think that's going to impact too many people there. This one, so this is not really as much of a tax item, but you may have heard of these Trump accounts. And I resort a little more to guys like Thimble Island Private Wealth to tell us, what their thoughts are on it. I've kind of heard differing opinions personally. Right, the focus of it is to fund future children's retirement. I think government seeing where people are going, not saving enough money, it's a problem. Social Security system has issues. So this is, Trump and Congress's attempt to try and get kids, I think, money earlier. So there are some limitations to this as it stands right now. And I've seen some drafted stuff. Honestly, I haven't focused on this a whole lot, but I know you can't put more than $5,000 in a year. I don't think that matters who the source is coming from. I know last time I took a seminar, they're not sure, well, if mom and dad and grandma and grandpa and your employer are all contributing, is it a 5,000 overall arching cap? I believe it is. You can't fund this thing till the middle of next year anyway, so I don't think they've finalized all these provisions. There are investment restrictions. I think it's got to be low cost mutual funds and ETFs that we're looking at here. So it's very limited, safe investments. No distributions are allowed before age 18 of the beneficiary. I think this was the big benefit to me is, if you're having a kid now, the government's going to fund $1,000 if you open up the account. So to me, it's like, why wouldn't you open up the account to get the $3,000 from the government, right? It's kind of like, here in Connecticut, they do that with the 529 plans too. If you open the chat, I remember when I had my kids, they fund 250 or they match 250. So it was kind of like, why wouldn't you do it? It's kind of like free money. So that's to me where I see it. As far as, is this better than a 529 or better than funding other things for kids? I can't really speak to it. It seems to me like it's a little similar and it might have more restrictions. So I don't know if it's the way they'll go, but that's why we got guys like Matt and their team over there to help us figure that out. Employers, it'll be interesting, like me, right? Do a lot of work with businesses. There's some provisions there. Employers can put up to $2,500 a year on behalf of employees that have these set up for the kids. And it's not taxable income, the way I understand it right now. So that's huge. Now, are they going to allow a tax deduction to the business is my question, right? If they do, I think this would be a great benefit for businesses to look at and say, hey, we can get tax-free income to our employees, this way. This is going to be a nice incentive to bring people, aboard or help out or offer something different that other people aren't. So we'll see. I think there's more to come on this still. And then kind of related to that, we've got a little bit of an expansion of the 529 accounts. And this is effective July 5th of 25. I mean, there's some weird dates in this bill. That's why be careful. Some things are retroactive 1/1/25. Some are 1/19/25, which I think was the date of inauguration. Some are in the middle of the year and some aren't until next year. So this, I think really the big thing I'd say is it covers a lot of stuff now, right? You're in private schools. You have, educational materials you need to get. You have post-secondary credentialing programs you're working with. I mean, continuing professional education, there's a lot of stuff. So I didn't want to list everything here. I would just say most of the time when people ask me the question, do you think this is covered or not? I'm like, yep, yeah, it is. So, test fees, there's lots of things in there. So to me, I tell people when they ask me, should I be putting money into a 529 plan for the kids? It's like, well, if you think you're gonna have any of these things, like, why not? Especially like here in Connecticut, where we've got Connecticut's going to give you a tax deduction. One of the very rare things Connecticut allows a deduction for. There's not much here that we allow. So to me, it's like, yeah, probably should put some money in there because you can cover these things and use it tax free. It grows tax free. It's just part of your diverse portfolio approach, I would say, to say, put some things in there if you think, and then you have that ability, to roll this money now in the future, and Matt, those guys could talk about it, into a Roth IRA with some limitations there as to how much you can do annually and over the lifetime, but just seems like another way to do something, good.
Yeah, and I'll just jump in real quick on that too,
Right.
Steve, is that's what we talk to a lot of folks about when it comes to 529s. With this sort of expansion of things that it covers, we're seeing them make more and more sense for a lot of people. Obviously, we want to talk to you about, the individual situation, some of the goals that you have, et cetera. But more and more, it's a great way, as Steve was saying, you get a little bit of a deduction from the state of Connecticut. It grows tax-free, and then the distributions, as long as they're for those qualified expenses, which now seems to cover just about anything, then it's tax-free distributions as well. And then anything residual that's not used for, education, et cetera, you have that ability to do those sort of serial conversions, as we'll call it, up to, I think it's about 30,500 or 31,000, right around that level, into a Roth IRA for the beneficiary of the 529. So again, can help with that retirement funding down the line there as well. So we're a big proponent and advocate for the 529 plans here.
Perfect. No, appreciate that, Matt. That's great. So the last thing here kind of is on the provisions ending, right? So with all good things, there's got to be ways to pay for the bill in some of these tax cuts. So I think these to me were three of the major ones that impact a lot of people that I saw what happen and people utilize in the past few years, especially. So the clean energy and vehicle tax credits. So that was your electric vehicles, buying Teslas, buying those types of things. They were starting to phase out anyway, because these manufacturers did hit some of these thresholds that were in previous bills set up many years ago, but those are essentially gone after, a couple weeks ago now. So nothing we can do there. The energy efficient home improvement credit. So that's kind of bounced around. The history of that was, many years ago, it was an annual credit, then it was a lifetime credit, and then it went to an annual credit for the last 4 years or so, and now it's going to be gone forever. So that's when you did the windows in your house, doors in your house, insulation type stuff, boilers that were energy efficient. You'd get a few $100s here, a few $100s there. So that's gone at the end of this year. So hey, if you can get something in, maybe you get that in before the end of this year to get that credit. And then the residential energy credit for solar stuff, which was a lot of things people have been doing, that's going to be ending as well. So there's a lot of things here that, people were, thinking. I guess in my mind, if somebody asked me, what should I do? I'd be like, hey, try and get it in right now or try and wait 4 years, right? Because I think we all know where we're going in the world, whether you're for clean energy, not for it. I think as a nation, we're moving towards it. So these things come back in 4 years. They can go back in a year or two too. There can always be, changes in the bill. But I think, we may see these things reinstated 4 years down the line as well. So try to time it if you can. Is there anything else there? Oh, and then the business stuff. Yeah. So I didn't want to go too much into the business. There's lots of little nuances in here with qualified research expenditures and things. And you know what? I don't know the group who's coming to attend, so I didn't want to bore people. But here's the big ones I think that affect most people if they're working in the business, have any type of business, whether it's Schedule C, S Corp, C Corp, a little small LLC. So the 20% 199A QBI deduction, that has been made permanent. I mean, that is huge. Once again, with anything that's made permanent, just takes an act of Congress to not make it permanent, so we might see that happen. But that's something that's big that our clients have benefited from immensely over the last 8 years here. So I'm glad to see that that's back out there and will be staying for the next 4 years, which is a federal deduction, saves us on our taxes there. There was a lot of talk about the specified service trades and businesses, being exempted from this and really not getting it at all. That would be, hey, the financial advisors, the accountants, the attorneys, the doctors, they didn't make any significant changes. A lot of people in our industries phase out anyway and don't get it. So it's not like it's guaranteed for any of us, but they didn't significantly change it and say that nobody will get it. So if somebody's making under the income thresholds, they could still qualify for this, or paying wages, things that might qualify them for it. The bonus depreciation, this is massive as well. We were anticipating this to be reinstated. So a business goes out, buys a big piece of equipment, furniture and fixtures, there are various other items that qualify. This has been out there. It's bounced around over the years from, it was 50%, then it worked its way up to 100%, then it was working its way back down. It was set to be 40% this year of the cost of that new asset. And it now has been reenacted back up to 100%. So once again, looking at that date, January 19th of 25, very specific date that's in there, but that is huge for businesses. Again, there's state limitations there. State of Connecticut makes you add 100% of that back and then deduct it over 5 years. But still federally, where the majority of tax is getting paid, that would be eligible. And then our Section 179, which is our other way to write off fixed assets and capital expenditures that we are acquiring, that's been doubled up to $2.5 million. So between the bonus depreciation, the 179, which you can utilize hand in hand sometimes, those are big things. And the phase out threshold is now 4 million of assets purchased. So you can buy up to $4 million and be able to write off $2.5 million through this way. Those are, I think, the key ones that I wanted to just bring up that are in this bill. There's a lot of other stuff that I'm not talking about, but hopefully this gives you a little baseline. And happy to answer any questions at the end if there's something I can do or follow up with anybody there. But with that said, Matt, I think I'll turn it over to you.
Terrific. Thanks, Steve. And again, this is, as Steve mentioned, sort of, we'll call it scratching the surface, on, kind of what was in the bill from earlier this year. One of the things I think hopefully you picked up on, that Steve mentioned a couple of times, there's still more to come on a lot of this information, meaning we've got kind of the general framework, but we don't know exactly how it's going to impact certain individuals. There's still some guidance that's hasn't really been we'll say clarified out there on some of the additional items within the bill. So again, we would always advise you that if you're thinking of making some changes in strategy, whether it be from an income standpoint, a portfolio construction standpoint, definitely if you don't have a team, we'd love to talk to you. But again, coordinating with your CPA, your investment advisor, making sure things are, you're on the same page in terms of how the portfolio is constructed, really is a great way to ensure you're taking advantage of maybe some of the opportunities that are out there, but also making sure that we're trying to keep you maybe under certain thresholds so that you can take advantage of some things. As Steve talked about, there's phase outs with a number of the items that he discussed today. And that's where we can really kind of help you and review the portfolio for tax efficiency. And really what that does, when we do that, we look and we say, okay, how efficient are the tax efficient are the investments within the portfolio? Do you have high turnover mutual funds that are maybe kicking off capital gains at year end that may put you into a higher tax bracket? Steve talked a little bit about pass-through gains. What does that look like for you on an annual basis? And is there any sort of tax cost ratio or tax drag within your portfolio that maybe is holding you back in terms of some of the returns that you might have? And are you paying taxes when you rebalance? And then are you paying taxes on income that you're not spending? These are sort of the questions that we like to ask when we're taking a look at a portfolio to say, okay, is this set up in the most efficient manner for the goals that you have? And a lot of what we also help folks do through the planning process is, as Steve mentioned a little bit too, is help you develop that sort of diversified retirement income strategy. And that's really all. The way I boil this slide down, there's a lot here, but the way I like to boil it down is to asset location. When do you need it? And then how do we help you invest it accordingly to when you need it, to give you that sort of combination of, as you can see here, tax deferred accounts, taxable accounts, and then tax-free accounts. And that last one is always one that perks up folks' ears. But Steve mentioned it as part of the opportunity, investing in a Roth, providing tax-free income in retirement within a Roth, as long as you have it open for 5 years and over 59 and a half. So if you're just starting out or, kind of, we'll call it in the middle of your career and haven't thought about Roth, that's a big thing that we talk to folks a lot about, utilizing that in your plan moving forward. And candidly, if you're approaching retirement and maybe you have a lower income opportunities, we can even maybe help with a thing called a Roth conversion, if it makes sense. And that's where you basically can take the IRA dollars, those traditional IRAs or 401ks, and convert it to a Roth. You do have to pay some taxes when you do that. So that is a very detailed conversation that we have with you, your accountant, a CPA partner, to make sure that if we're going to do something like that, we keep you under certain thresholds to ensure that you can still take advantage of some of those benefits that might be out there. And really, it comes to managing that tax liability in retirement is one of the big things that we really try and help folks with, going forward. So, just sort of in summary, investing in today's environment and then considering some of those different strategies, it's a real challenge. And that's why we really advocate for, working with a professional team, a CPA partner, an investment team to kind of help navigate and help you manage some of those challenges as they come. And then, always knowing that, some investment decisions that you make can have tax consequences that you might not consider. That's part of that portfolio review where we look for that tax diversification and say, okay, how is it inside the portfolio? And then there's opportunities where you can use some of those tax deferred types of vehicles, like a 401k plan, an IRA, to put some extra money away, help with the taxable income, and then allow you to grow that money for the future. And a lot of what we do with portfolio construction is talk about where we're going to take risks in certain areas of the portfolio. And traditionally, a lot of the times where we advocate for higher risk types of growth opportunities, if you will, is inside those tax deferred vehicles. The opportunity where you can have it grow and not have to worry about paying the taxes each year until you decide to take that money out. That's a real opportunity where we think we can help you moving forward. So, with that, again, hopefully we're just under the 45-minute mark here. We really do appreciate you guys taking the time here today. Hopefully you found some valuable information in there. As I mentioned at the beginning, if there's questions, we're certainly happy to answer a couple now. If they're more sort of what I would call detailed, maybe one-off specific to your individual situation, we'd love the opportunity to sit down with you, talk a little bit more, and we can loop in a tax partner like Steve, or, if you have a CPA partner that you currently work with, we can kind of have that conversation together. So what you can expect here kind of going forward is we're going to send you a quick follow-up email, with just a thank you, but also some of the information that we talked about here today. We'd love that opportunity to sit down with you and talk about a plan if you don't already have one in place and how we might be able to help. And then lastly, this is, as I mentioned at the beginning, it's our first Financial Friday, sort of what we'll call quick hit sort of informational session. We are going to have another session next month, so be on the lookout for that. That one's going to be focused around tips and strategies for healthcare planning and retirement. So focusing a little bit more on Medicare, and what kind of that whole strategy looks like in terms of how do we help you plan for that. And we're going to have a specialist joining us to talk a little bit about, how he helps folks navigate that market as well. So with that, Brian, I don't know if we have any questions that have come up in the chat, but if not, again, we really appreciate the time here today. And I don't think, doesn't look like that we have any questions. So, again, if there are questions, feel free to send us a quick email, and we'll be sending that follow-up email here the beginning of the week. And, again, can't thank you guys all for enough for the time that you took here today. And we look forward to hopefully talking with you more here in the future. Thanks again.
Thanks, Maddie.